everyone. In today's video, we'll be going over how to trade fair value gaps. A fair value gap, as it's often referred to, is basically a gap that forms when the buying and selling forces are wildly out of balance. There's a number of things that can cause this mismatch, including major news events, the release of certain economic data, or even hefty trades by big institutions. So let's talk about how price action traders view fair value gaps. They often see these as chances to jump into the market, banking on the likelihood that the market will swing back to cover the gap before it continues on in the direction it was originally heading. There's a few key components of fair value gaps I'd like to cover before we look at examples. Fair value gaps are price jumps due to imbalanced buying and selling pressures, viewed by traders as opportunities amidst market uncertainty. Fair value gaps can be spotted on charts as large candles not fully overlapped by the wicks of neighboring ones, differing from small gaps that don't show significant buying or selling imbalances. Trading strategies for fair value gaps involve buying or shorting the gap, using fair value gaps as support and resistance levels, and implementing various indicators and stop losses. So what does fair value even mean? To really get how fair value gaps form, it helps to understand the idea of fair value. Now, fair value is the price point where a security would be trading if the buying and selling forces were perfectly balanced. When there's an imbalance, that's when the market price begins to drift away from this fair value. In a fair value gap scenario, the market price will create a gap, either upward or downward, to a level that's closer to fair value. This happens because the imbalance in buying and selling pressures will eventually find a way to correct itself. So when you see a fair value gap pop up, it's essentially waving a big flag saying, hey, there's a lot of uncertainty in the market right now. This kind of uncertain environment can actually pave the way for opportunities for traders, particularly those who rely heavily on price action. With any trading strategy or indicator, it's important to note the pitfalls and risks associated with that. In regards to the fair value gap, it's important to keep in mind that the market may create these fair value gaps, but not trade back into them, or it will trade back into them and trade through it to the opposite side. So I like to use fair value gaps in conjunction with my original technical analysis and thesis for the market. The thing that I have found most useful when trading fair value gaps is to observe when price breaks market structure. When it breaks market structure with a significant move, it has more of a potential to create a gap. So here we have price coming up, creating higher highs, higher lows, higher high, higher low, higher high. And at this point, the market started to fail. And you can see here, price moved down about 22 ticks. And in this section, from the bottom of this candle or wick to the next one is where the gap would be. And if you just extend that out to the right, that would be your fair value gap. You can see price came back up in to try to fill the entire gap, but it missed it by a tick or 2 ticks. That could be potentially your short entry, or you could use it as resistance. But that would be a fair value gap. Again, here we have price making higher highs, higher lows, made a new high from this one, started to come down, and then looked like it was going to go up, and then we had a significant price move down. Between the bottom of this wick and the top of the next one is the gap. If we extend it over, we can see price came back up into the gap slightly and then continued to move down. Now it's important to note that, again, like I said, not every indicator or trading strategy is perfect. I think it's important to use fair value gap trading in conjunction with your sound and logical thesis, with solid technical analysis. But if you were at a point where you were starting to look short here before this significant move down, this would have been a good indication that, okay, price broke market structure, there's uncertainty in the market, and there's a shift happening. So when that happens, that's when we can start looking for the fair value gap and find potential entries for a continued move down. Fair value gaps appear on all time frames. So these that I noted were on the 2-minute chart. On the 1-minute chart, you can see there's obviously more candles, but what that's going to do is it's going to change the wicks of the neighboring candles. So if you were trading a 1-minute or a 5-minute, it's going to look different. But what I like to do is do a top-down analysis and try to find them, let's say on the 15. If you don't find any, go down to the 5, the 2, the 1. But if you were trading the 1, we would just move that there. Again, the base is here, and we still have price coming back into that fair value gap. Now, one thing I'll note is on the 2-minute, it looks like there's a gap here. If we go over to the 1-minute, again, it's just slightly different and a little wider, but it's the same concept. We have a large candle and the neighboring wicks leave this area exposed, creating the fair value gap. And again, if you were biased short, this would be a potential entry for a short position, or if you were looking to take profits and have this retest, it could be a potential for an exit on your long. When you're trading fair value gaps and you're trading them in conjunction with a shift in market structure, it's very important to know where your stop is going to be as well as your take profit. So here we have, again, prices making higher highs, higher lows, and then we can see in this downward rotation, we break market structure here and here. So if we were anticipating for this low to be taken out, and this was a valid break in market structure, and we did enter here, we could essentially put our stop above this high, anticipating that it's not going to make another high, and put our take profit below this intermediate low, anticipating that it will make a new low. And in order to do that, or to measure, we could use the price target feature and say we wanted to enter in this fair value gap. We would switch this to short. I'm going to move that out of the way. So our take profit would be below this intermediate low, and our stop would be above the recent high, and we could quickly measure our risk to reward ratio. Again, on this fair value gap, if we wanted to measure our risk to reward, we would create the fair value gap with the rectangle, click on price target. Let's say we wanted to enter at the beginning of the fair value gap. Let's say we thought this market was extremely bearish and the likelihood of filling this gap completely was minimal, and we want to enter a tick into the gap. We could go there. Again, we will switch this to short. Our take profit would be below this low, stop loss above that high, and we would quickly get our risk to reward of 1.68. To recap, fair value gaps are price jumps that happen when buying and selling pressure are not balanced, caused by things like big news, economic data releases, or large institutional trades. Fair value gaps can be risky. There are pitfalls. Not all gaps are fair value gaps. Small gaps, for instance, do not signal a significant buying and selling imbalance. Fair value gaps show up on all types of time frames. What we're looking for when trying to identify a fair value gap is when there's a significant price move where the neighboring wicks leave a portion of this candle exposed, creating that gap. And it's also advised to use a mix of indicators, stop losses, wait for confirmation, and be patient when trading fair value gaps. Thank you. That's all I have for you today. I hope you enjoyed the video. And if you have any future questions, please visit us at optimusfutures.com. Thank you.